Stocks set for a lackluster open this morning, it seems, south of the border. Let's get more from Drew Pettit, Director of US Equity Strategy at Citi. Drew, always great to see you. Thank you very much indeed. When people ask you about valuations in the market, now I know it's a very broad question, but what leaps to mind?
So it's funny, it's not PE ratios, it's not price to book, it's not a lot of those traditional metrics. To us, it's the growth rate you need to justify the prices today. So what's standing out to us for only the third time in history, there is more index value ascribed to excess or structural growth than there is the current earnings level. So to kind of spin this differently, you haven't seen pricing and growth expectations this high except for the tech bubble and coming out of the, I would say, COVID lockdowns. So to us, it's growth expectations are really high, and that's putting a lot of pressure on earnings to deliver for this bull market to keep going.
So you said excess growth expectations. It sounds a bit like the economist term, excess profits, where companies earn more than you'd expect under normal competition. But so what do you, the basic story here is that we've got, maybe not exponential, but very rapid expansion priced into the market.
Yeah, there's a lot priced in for, I'm going to call them structural growth drivers, not cyclical ones.
Oh.
So there is an expectation that the S&P 500 and a lot of these companies in the United States are going to grow somewhat in line with GDP over time. But the S&P 500, as I've said on your show multiple times going back, over a year now, the S&P 500 is not the economy. They are very different. And with this tech bias, especially with this structural AI growth tailwind, the market, investors, everyone is expecting earnings growth to be well in excess of, let's call it 2 or 3% GDP growth. So when you look at market pricing, it's pricing this in, not just in the big like Mag 7 tech names that we see, but in a lot of the infrastructure and AI value chain names as well. So there's a lot expected of a lot of companies that isn't just going to be driven by how much more consumers can buy in the United States.
You reckon, I love this metric, return on equity. You said that the return on equity in the S&P 500 in terms of profit that shareholders have tied up in companies could hit an all-time high?
Yeah, this is really interesting. So markets pricing in a lot of growth, but analysts, when they think about return metrics and quality like ROE, we actually think are a little bit too conservative. So this is where, again, we stay structurally bullish on U.S. equities, even when we get concerned short-term or tactically about valuation. It's interesting. Profit margin should move higher. The One Big Beautiful Bill Act in the United States, it is a tailwind for a lot of companies, and it offsets, any potential tariff headwinds. But what is really, really interesting under the surface, analysts are actually not modeling efficiency to get any better. If you listen to corporates talk, they're talking about how I can get more sales per employee, how my selling price for my products can go up with new tech integration, and how I can just make operating processes, forecasting, and so on better in the background. And then the analysts go back to their models and they don't factor any of that in. So yeah, they see profit margins going up mostly because of tax, but efficiency to us should still go higher. Sales growth looks good. Yeah, there's a lot of CapEx investment, but it's turning into something real. So if efficiency stays the same as it was this year or ticks a little bit higher, you can easily break ROE to all-time highs, which justifies higher implicit growth expectations.
What about the question of Mag 7? Are you inclined to recommend underweighting them relative to the market?
No, it's funny. We're actually a little bit picky on Mag 7, but if I had to cluster it all together, you still want to hold and own these secular growth names. It's funny how we kind of pair it is those names with some interesting kind of cyclical plays on the other side. So for example, we like the Mag 7, but we also like banks and financials. Pair those together, it works really well. We like fintech, which kind of stays out of traditional AI. We like digital leisure. So